Right, so it's I guess a bit of a wrap up of the US overnight and two-thirds of the way through the Australian day session, the Asian session. Um, Really, there's not much to say on a lot of these apart from all these ones I've basically got a line in the sand in red, and you can see on the US equities, our equities, and also the Aussie currency, they're all right on it. And I guess this is the pointy end of technical analysis, because when we look at these moves, this is as deep a retracement as you want to get, right? 78 retracement. So it obviously coincides with where it's just stalled, like the last couple of days. It is right on that 44.80 level. It's ticked a little bit high. It did as high as 44.93, the futures in Asian time zone. So it's overbought on the 4-hourly, starting to come off a little bit. It's certainly come off on the shorter time frames. When we look at the hourly, it's come off negative divergence. So the negative divergence has shifted from the 15 minutes now to the hourly. I'm not sure if it's showing that on the 2-hourly yet. Yep, showing it on the 2-hourly. Not really on the 4-hourly. But there's some of those indicators are saying that it's just starting to turn. It's on a key line in the sand there, just nudging through this previous high and the 76. And if it goes much further, then that is pretty much game over for the correction, and that will be the start of a new trend. It really still is trying to find what the new trend will be. So despite this one being broken, right, depending on however you want to draw it, it's broken. It didn't last very long. Still wasn't as deep as what I suspect. As far as where could it go to if it does reject this level, okay, you can see that is down that 4200 level and also into the 4000 zone. They're the targets if this is a corrective wave as deep as it is. We'll see a similar pattern in the other markets. So that's the US market. It's all about this 44.80. Is it going to reject it or go through? That's pretty much the story until something decisive happens there. In the Australian market, we can see we've got a similar red line in the sand. And our one is exactly the same. It's right banging on it, nudging through, hasn't decisively broken through it yet. The retracement isn't as deep. It's a 61.8, but you can see it is like it's right where it's sitting. It is right on there. I am a bit of a subscriber to Fibonacci's. Like, they do seem to provide pretty natural levels. The 78 level retracement, you'll see that's a previous important level that it rejected. So, but the red line in the sand is clearly here for our market. And where would it go to based on those extensions? Not dissimilar to some of these zones that we find in the US market. I don't see it going down here, although it certainly could. For me, this gap in here has always been the target, waiting to be filled, waiting to be hit for this corrective move. As you see, that one there, that's the 23 retracement from the whole move, right? Since since the COVID crash, and so that's why it would be. I mean, there's a few technical reasons why it would make sense for it to come in and fill a gap in here. So that's our equity markets. The Aussie dollar market, similar situation. We've got a red line in the sand here. Again, this trend line has been broken. It's looking for to form a new trend. This to me does look like pretty corrective, due for a follow through. And if we look at the retracement, if you take it from there, right, it's right on, just a tiny bit through this 38 retracement. I guess if we take it from up here, where does that take it? Yeah, so from there, yeah, so it's right on that 38. Wash, take out that noise there. So it's right on the 38. So the currency's on the 38 retracement. The Australian equity market's on the 61, and the S&P 500 is on the 78. So the US has retraced deeper, so it's been bought back more strongly than the Aussie market. And you can, so the Aussie market, did hit quite a good target there, and that's, I guess, one of the differences between the currency and the equity markets. If it's going to extend, right, we'll take it from here, this move, right, to me, that looks a pretty good target, like that 65, but certainly somewhere down, that would be first stop. Somewhere down here, that would be a sound technical target. One of these, like, you know, that 70, that would be the first stop. I think it's quite likely, if this red line in the sand holds, it is going there. I'd say I bet money on it. I have bet money on it. I'm still short. So I'd say it would go there as a target. Depending on the momentum, it could go further. But that looks a very sound level for it to go to. Look, that's it for the equity markets. The treasury yields are still on the move, which doesn't bode well for the equity markets. So I'm surprised that the equity markets have rebounded so strongly despite the move in the bonds, particularly the long-dated bonds. And we can see as far as where this could retrace to. Sorry, this chart is reasonably messy. This, you know, like wave here, they're kind of a daily, right? It's a weekly one. Could see it come back to, you know, this 240 level, and you can see there's been a bit of, let me get rid of some of the noise in here. It could come back, you know, that's been a level that it hit as a low previously. This one would be interesting because it is really the level where it broke down from around here. So for me, that point there and where it traced through, that's not a line in the red line in the sand, where it's going to hold. To me, that is one target. This one is another target, and you can see they line up pretty well with these, you know, some of these Fibbo retracements. Or project extensions where they go. That's what I'm looking at, and this, to me, it doesn't look like it's going down. I don't think there's anyone suggesting rates are going to be staying lower for longer. It's all going to be raised sooner rather than later. That's the consensus, and the market is responding. It's broken through these lows here, and to me it looks like it is heading higher, which cannot be good for particularly the Nasdaq and therefore the S&P, which reinforces my view that the S&P, although it's heavily retraced, it is lagging this move a little bit. And as you might remember from the other day or a previous video, this move here of 190 points, that's what led to, or was part of the correction in 2018, between basically the last quarter of 2018, when there was a 20% correction, which started, you know, in September and finished, you know, basically 3 months later. This move is looking remarkably similar to that one. We are halfway through ours, right? You know, that's like 130 points. If we take it to 190 points, okay, that takes it through to that 240 level, which I'd say is, I think from memory, yeah, it's one of those extensions, right? It's that level 253. It's just in just in there. If we take it from the breakout point there. So that looks like the target. That's not going to be good for equities. I've got my eye on watching those treasuries sell off further, which could trigger some more selling in the equities. But for now, all these markets, especially the S&P, the big one, it's this red line in the sand which is just nudging through. And we'll see how that goes over the next few days. Now, my famed seller of the 17th and 18th of these, the previous 1, 2, 3, 4, 5 months, hasn't emerged. They were due to do that overnight, and they haven't done that so far. We can see here that we are in the time slot for them to do it. And they've got basically, my calculations, got one more day to jump in. Otherwise, well, whatever they were doing is they're done for now. To me, it's still a little bit inexplicable what happened on these trading days, apart from that a common theme of significant selling, which then exited the market. That hasn't happened a sixth time. So lightning struck in the same place 5 times, but not a sixth. So no Michael Burry award for me this month. All right, catch you later. Ciao.